Hello, everyone, whoever has joined us on Zoom. We're setting up the Facebook Live and then we'll start. Just bear with us for a few more minutes. Hello, everyone. Welcome to the third session of VC101 by MENAbytes and Modus, the online bootcamp for early stage founders who are fundraising. Thank you, Kareem, for joining us once again for this session. Hope you're feeling better now.
Thanks. Awesome. Feeling great. And thanks for having me as always.
Thank you. So for those who are joining us, we've already done two of these sessions. If you're joining us for the first time, you can perhaps go back and watch those other two sessions after the end of this one. Those who are joining us on Zoom will have the option to ask questions during the session. Kareem will be answering their questions around those topics that we're going to discuss today. And then there will be a private about 30-minute Q&A as well, where those who are joining us on Zoom will have the option to share their questions or even ask Kareem about anything else that they may have on their mind around venture capital. So let's just get straight to it, Kareem. Do you have slides for today that you would like to present?
Yeah, I got a couple of slides. Let me start with that.
Sure.
All right. So let me know when you can see my screen here.
Yes.
All right. So first thing we're going to talk about today is some of the terms for mechanics, right? When you're talking about investing. So first that we had is vesting, right? And this is essentially a metric-based conversion of ownership. Best way to explain this is, for example, employee vesting or advisory vesting, right? So if you have, let's say, an advisor, that advisor may be somebody who would be getting a percentage of equity, 1 to 2%, or a number of shares, right, in the company. And for that, they're responsible for maybe making some introductions, maybe helping with some business development, maybe even supporting your fundraising efforts, right? So what you would do is this advisor would essentially gain the ownership of the actual shares based off of him actually achieving those set milestones, those predetermined milestones. Now, doing this, what you see the way that you kind of see this term used the most is when you're talking about founders and employees, right? And this is primarily done to ensure that the talent is properly incentivized and that the talent is retained at a company. So, and this is something that is usually required by investors, right? From an investor lens, if I'm going to invest into a company and Zubair is the founder of that company and he is a subject matter expert in, he's a data scientist, right? And you're a deep tech company, right? And that is, that's integral to the success of the company. I want to make sure that Zubair, as an investor, is going to stay with the company for long enough or a certain amount of time to ensure that the company has him and his knowledge and his brains as a resource, right? So what we would do as an investor is you would essentially say that, okay, you have this ownership. You may get an initial amount of ownership up front right off the bat that is essentially vested, so you actually own that, and then the remaining can be split over a certain amount of years, right? To ensure that, you know, with every year, the ownership actually transitions from the company to you as a founder. Now, other founders and employees, you know, it's pretty much the same type of concept, but for there, it's you know, it's usually done in a little bit of a different way, or sometimes it's done a little bit of a different way, right? One of the ways is that it would still vest over a certain period of time, but there's a cliff, right? So what essentially a vesting cliff means is that if the individual leaves before a set amount of time, that they haven't earned any of that equity. So what would a traditional vesting structure look like, right, for an employee or you know, maybe a core founder? Usually 4-year vesting or 5-year vesting with a 1-year cliff. What does that mean? And from an execution standpoint, it means that you have, let's say, 100,000 shares that that's going to convert, right? And it's split over 4 years. So if you leave a day before your 1-year anniversary, right, you don't get any shares, right? At the 1-year anniversary, you automatically get 25,000 shares, right? 25% of your shares. And then what happens is the remaining vesting, usually it happens either on a month-by-month basis or a quarterly basis. This is what you kind of see. So what it would be is the other 25% would be split over the 12 months or by quarters. And as the employee essentially, you know, passes that timeline threshold, the vesting actually occurs. Second term is dilution, right? And dilution primarily relates to really the management of the ownership percentage, right? So if I invest and I own 3% of a company, or let's say for round numbers, I own 10% of a company, right? If I'm an individual, right? If I'm a founder, most of the time as a founder, you're going to get diluted, right? When you bring in additional capital, you have to essentially make room for the ownership. Where does that room have to come from? You can't pull it out of the sky. What you actually have to do is you have to assign percentage. Everybody who's on the cap table, unless you have an anti-dilution clause, which some investors require, they equally get reduced by a percentage in order to create room on the cap table, or to create more shares, or reassign those shares from the existing ownership shareholders, to be able to give that to new outside investors, right? So the dilution is essentially the management of that ownership percentage. Again, what you'll find is investors a lot of the time ask for some sort of anti-dilution mechanisms to ensure that they won't be diluted down to a very, very small percentage. This really depends on the investor, what their investment thesis is, and the actual opportunity, right? And again, for founders, it's something that you actually want to fight against, right? And in our last session, we talked about like how often should you raise money, or when is a good time to raise money, right? As a founder, the more progress you get and the better metrics and stronger validation and positioning that you have as a company or as a product, right, the less you are actually going to be diluted. So you will retain a higher level of ownership. So if instead of you getting, let's say you own 100% of the company, and you can easily raise, let's say, $2 million. But for that $2 million, you're going to go from owning 100%, you're going to be diluted by half. So you're going to own 50%, and the other investors are going to get 50% for putting in the $2 million. What you could do is you could only raise 500,000 and dilute yourself only 10 or 15%, right? So what you do is you can essentially, you want to actually, as a founder, go as far as you absolutely can on a very limited budget, to be able to be better positioned so that you don't actually dilute and you minimize the dilution. Now, related to dilution is pro rata. And this is essentially a mechanism to maintain your ownership percentage, primarily with money, right? So what does that mean? It means that if I'm an investor and I invested $100,000 to own 10% of the company, right? And the next time the company's going to go raise money, right, everybody's going to get diluted, right? If you don't have an anti-dilution clause. So if I want to maintain my 10%, I have to essentially I have the right to add additional capital based off of that subsequent valuation to maintain my percentage, right? So if I'm going to be diluted, let's say you're going to raise like another $100,000, right? And I'm going to be diluted 50%, right? I can actually put in $10,000 to maintain my 10%, right? To ensure that I don't actually lose my percentage. Now, there's other mechanisms that pro rata is used for. If you have a venture that pays dividends, for example, or is not, it pays profit sharing or dividends. Pro rata essentially comes in to say, if I own 25% of this company, right, then I'm entitled to 25% of the profits, right, the profit sharing or the dividends that come out. So that's another way that you actually use pro rata in a different structure of business, right? Not a business that is primarily growing to exit, but maybe it's a long-term, just revenue generating, profit generating business, right? And pro rata would work effectively that way. And then a couple other terms, drag and tag along, right? So this is essentially, think about it very simply, like if a minority investor, right now, they have a right to, let's say, stand in the way of a sale of a company, right? So Zubair, you're selling a company and a minority investor saying, I'm not agreeing to these terms, so I'm not signing the term sheet, right? If there's a drag along provision, what that'll essentially say is that the remaining shareholders can vote to actually pull that minority investor into the transaction, right? So they can't essentially block it, right? And a tag along, so that's essentially, that's throw them on the wagon, right? That's what I mean by throw them on the wagon. Tag along is the opposite. If there is a sale or somebody's exiting a company, right? A major shareholder, a minority shareholder may want that same deal, right? So in order for them to ensure that they get that same deal, they may exercise a tag along provision to say that I'm not going to be left behind. If I bought a share at $3 a share and now it's being sold at 10 and there's a tag along provision, I want to be able to exercise my right to actually exit with this other investor that's exiting vis-a-vis the tag along provision. So those are some of the main term mechanics or terms, and they really, again, speak to the mechanics in which the ownership structure is manipulated or managed within a company. You're on mute, Zubair.
Thank you, Kareem. So when we talk about vesting, is it a good idea for the founders to agree on a vesting mechanism from day one for their own equity as well in the company?
Yeah, I highly recommend it. I think that the less ambiguity that you have when you're engaging in a company, right? If an investor, because you have to understand especially founders, right? Because what they put in is a lot of time and sweat, right? They have opportunity costs, right? You don't found a company as a founder and get paid lots of money. Sometimes you don't even get paid, right? So your compensation is your ownership in the company. So the best thing that I always recommend is be super clear, be super transparent, always make sure that everything is documented, and make sure that you have these kind of things figured out, because down the road, the less ambiguity and the more clarity there is, the less problems you're going to have, right? And the less friction that may arise out of it.
Right, thank you. And when we talk about dilution, is it also important for founders to be able to think, especially when they're at their early stage, that they should have enough equity for the later stage investors to be able to come in and invest in the company?
Absolutely, that's a very good point. They definitely have to think about making room for additional investors. The other thing that they have to think about, and investors also have to think about, is, are the founders going to be diluted to a point that they're not incentivized anymore, right? So if as an investor, you take too much equity from the founders in the beginning round, right? Then in 2 or 3 rounds, their percentage ownership, or that, it may be down to like less than 1%. So now that founder and that talent, and the whole reason why you have vesting, because you want this individual or this team to kind of stay at the company to reap the long-term benefits, you're essentially taking that long-term benefit upside away from them, right? By them having too little skin in the game or upside, right? So they may say, oh, well, I'd rather go and work for another company or start another company where I'm going to make more money or have a better vesting structure. So it works
Right.
both ways.
Right, absolutely. And there's obviously no rule, but what's the standard that you keep seeing, especially in the region at early stage? Is it 20% dilution at seed level and then 20% in the subsequent rounds, or what do you see normally?
Yeah, it really, it's really tough because it really depends on the company, and it
Right,
depends on, again, the narrative, right? If a company is very strong and is in like hyper growth, right? They have the ability to push back against investors and give less, right? Investors, there's a higher chance that the investor's money is going to be worth something and get a good return. So less amount of shares doesn't necessarily equate to less amount of return for the investors, right? So it really depends. I mean, to put a standard to it in the region is really like just getting settled. It's very, very hard, but I think the percentages that you mentioned, that's somewhere around average.
right. And the terms drag along and tag along could in any way be used by the investors to create problems for the founders in the future?
It depends. I mean, if the founders, it depends if the founders are minority shareholders or not, right? Because then they fall into that. The drag along and tag along can specifically identify the founders to be able to drag or tag along into it. It's you know, could it be problematic? Yes, it can be problematic. A founder may not want to sell a company. He may think that, the investors may see that, look, this is a good opportunity for you to sell the company, right? But what they're doing, and if there's no drag along provision, the entrepreneur or the founder can say, no, I'm going to build the next Google, right? And I'm going to keep growing this forever, right? But the investors, there's a consensus that no, this is a good time for us to get out and get our money's worth because they see something in the market that maybe the founder doesn't see. And they see that they're going to have challenges in the future, or that it doesn't have the ability to grow beyond where it is right now, right? So a founder may want to maintain, not selling the company. And if the provision isn't there, then the investors won't be able to force them into it, right? And you just have to use your diplomatic skills and people management at that point.
Right. And when we talk about pro rata, if an investor has this clause, they still have the option either to invest or not in the future rounds of the company to maintain their stake.
So this is for pro rata?
Yeah. So they
Yeah,
have the
correct.
option. It's not mandatory that they will actually invest in.
Correct. It's essentially like a first right of refusal. If you want to maintain your equity, you have the ability to put in this much money to maintain it. Otherwise, they don't, right? Otherwise, the founders of the company can essentially go and raise money and only take new money, right? And not allow the existing investors to invest more money.
Right. Right. Thank you. I think we don't have any questions from the audience here on Zoom, so we can move on to the next slide. They're probably
Sure.
saving their question for the private session.
Okay. All right. All right. So next is talking about a convertible note versus a safe note, right? The main difference between a convertible and a safe note is a convertible note is debt, right? It's essentially a loan that converts to equity upon a trigger, right? And a safe note is not. It's not debt. It's just a straight conversion of a note for future conversion into equity. So a convertible note, the fact that it carries debt gives the investor the option to either say, I want to actually exercise the conversion, or I don't, I want my money back as a loan at X% interest, right? And that's one of the points that I actually don't have listed here, but for a convertible note, it applies, right, is an interest rate. So if I give you a $100,000 convertible note at somewhere between 6 to 8% interest, which is usually industry standard, I may again say, okay, after a year, it now comes to the point where my note is either going to convert or it's not, and I can call it back as a note. I can look at the company and say, you know what, I want it to convert into equity in the company. I just want to get my principal back plus the interest on it. And that's the way that mechanism would work, right? A safe note doesn't have that, right? It doesn't have that. It's strictly for ownership conversion. Now, some of the things that is shared between a convertible and a safe note is a valuation cap, right? These are instruments essentially created for early stage company to facilitate their ability to raise money, right? So what does that mean? It allows you to circumvent the need to actually identify or determine a price per share until a later date, right? And what that does is you don't get into the discussion of what is the valuation of this company right now and have a fixed dollar amount per share in the company, right? But at the same time, what you don't want is you don't want the founders, as an investor, you don't want the founders to say that you invested $100,000 into the company at a $1 million valuation, right? That gets you 10%, right? For them to say, oh, well, when this converts, it's actually worth $10 million. So you're not going to get 10%, you're going to get 1%, right? So a valuation cap essentially ensures that the minimum percentage ownership of an investor for the money that they put in. And that's essentially, so that's essentially what the valuation cap is. Discount. So usually, because it's first money in, right? Usually from angels or some early stage VCs. These instruments, they're much higher risk, right? They're taking a risk. They're very, very early on. The company's in the idea or early validation stage. So there's a much higher risk. So one of the things that is a negotiating tool for both the entrepreneur and for the investor is a discount, which is essentially a kicker. It's additional percentage of ownership for the money that they put in. Traditional discounts, you see them anywhere between 10 and 20%. More than 20% usually don't really see a lot. So if I'm going to put in that $100,000 at a 20% discount, I'm essentially going to be getting $120,000 worth of equity, right? That's what the discount, that's the way that the discount mechanism works. So it's essentially getting more ownership for the dollars that you put in, right, per the percentage of the discount. The next is liquidation preference. So there's a couple types of liquidation preference in these notes. One is a liquidation preference before the conversion, right? So there's a conversion trigger, and we'll talk about that next, but that's essentially an event that happens which forces the notes to actually convert into equity. And if the company is sold prior to that, right, there's usually a liquidation preference that goes to the investors because they came in early, right? So if it's 1x or 1.5x, they're going to get 1.5x on top of whatever the on top of whatever their principal amount would be getting them, right? And that's, again, something that's used to incentivize investors from either the entrepreneur or investors require it because of the risky nature of this early investment. Now, again, conversion trigger, which we just talked about very briefly, is essentially an event that happens that causes these notes to go from being essentially note mechanisms to actually ownerships per share. And traditionally what that is, it's either time or fundraising, right? So if there's a conversion trigger, if a company raises over X amount of dollars, right, then these notes will automatically convert, right? Or if there's a certain amount of time, 12 months, 18 months, 24 months, which is time-based conversion. So these are essentially triggers that make these go from the convertible nature, right, of these instruments to actually full ownership at a price per share. Another thing is transfer rights. This is something that's usually seen in these notes. This is something that entrepreneurs should really be careful about. Transfer rights gives the investor the ability to take their ownership through these convertibles, their ownership in your company, and essentially assign it to somebody else, right? The reason why you should really be careful is because you don't want an investor without your first approval, right, or first right of refusal to buy the equity back, for the company to buy the equity back, to give or sell these shares, right, to somebody that you don't know, right? That's really what it is. You don't want somebody on your cap table that you don't know, you don't have a relationship with. They may not be providing any value added, but there are legitimate reasons and there are things that you need to have transfer rights for. So in the event that, God forbid, an investor passed away, right, those transfer rights may need to go to his family, right? Or they maybe could be assigned to their family, or maybe there's a company restructuring, right? And the fund is going to assign the equity ownership from organization A to organization B, right? But this is as long as it's, for example, stated that it's under the same management, right? The same venture management, that would be like permissible, right? And then another thing is the first right of refusal to buy back, right? And this is essentially the company, before somebody wants to transfer, the ability for the company to say, well, we have the ability to buy it back and bring it back, these shares or this equity back into the company before you actually execute a transfer. And then the last thing which you find in some of these notes is a share class, is identifying when the conversion actually happens. Is it common stock? Is it preferred stock? And these share classes have things that considerations such as liquidation preference, which we spoke about earlier. This is now a liquidation preference, not pre-conversion, but now liquidation preference if the company actually gets sold down the road, right? The other thing is control and voting, right? Some classes of shares have more control mechanisms assigned to them, right? Like A, B class shares, for example. And class of shares is essentially made for you to be able to give certain incentives to certain investors, right? So you essentially have them segregated that way. So that's essentially the difference between convertible and safe and some of the common mechanisms that they all share. Now going to what's the difference between that and a price round? Now, a price round is what happens when these guys actually convert, right? When these instruments actually convert. And what you're doing in a price round is you're actually determining a value per share. And if you go back to our last session, we talked about valuation, right? How to negotiate it, what is it based off of, what KPIs and metrics. And again, as founders, I urge you guys to really try to control the narrative, right? Identify what are the key metrics and what is the story that you guys are presenting. If it's, a value based off the number of signups that you have, you can create an equation that say these signups will eventually convert into XYZ revenue, right? And just take the investors through the user journey, right? So that's valuation methodologies, which is the third point here. So again, a price round actually determines a set codified price per share that is assigned to every single share, and in turn to every single investor and founder. So essentially all the shareholders. Again, we talked briefly about share classes. Again, they can be. This is where you can create different share classes as well. You can create share classes that are around liquidation preference or other attributes, or again, control mechanisms. So price round is essentially a codified value for the company on a price per share, whereas a convertible and safe is what allows you to not have to do all of that determination, because as an early stage company, you likely don't have, data to substantiate a valuation, right? So instead of getting into this kind of valuation back and forth and price per share, you leverage these convertible and safe notes, right, to be able to get money in at a future perceived value, right, or a future perceived, with these mechanisms that are forecasted, until you get to an actual price round. And a price round is when the company hopefully has grown enough to where you can actually determine a proper value per share.
Thank you, Kareem. So when does a founder use convertible? When does he try to go for safe? And when is it a good idea to go for a price round?
So when to go for a price round? As late as possible, right? As late as possible, because it gives you the opportunity to get as much momentum and as high of a valuation as possible, right? This is what we really want. You want to be as efficient as possible with the money that you actually have. Convertible versus safe, again, they have a lot of mechanisms, a lot of the similar mechanisms. As a founder, if there is an investor that you're not sure if you actually want them to be part of the ownership structure or part of the investors when it converts, you may ask that you also have a right to, whether or not to allow this to convert or not, right? You'll get a lot of pushback from investors, but for example, at Modus, that's something that we do. We give entrepreneurs the ability to make that decision on their end as well as for us. From an investor standpoint, it's really just for them to be able to assess risk, right? So, okay, I'm going to make a bet today on a convertible that it may be safer for me to get my money in a year from now, or I may have enough confidence in this business that it'll continue, or maybe over that year I've found that this founder is a rock star, and yes, I wanted to convert, or I've lost faith in the founder because of the limited progress they've made. So I just want to be able to get the money back. So, it's primarily from the investor standpoint where they look at these two instruments and use them to decide what it is that they want.
Right. And also when it comes to choosing between a safe and a price round, there is one that is cheaper than the other when we talk about, the legalities and everything else involved to
Sure.
close the round.
Yeah, sure. So, to create a price round, you're now, there's legal requirements around, proper structure and governance, right? And you have more flexibility on that prior to an actual price round, but things that it's significantly more legal costs to do a price round. Why? Because in order to do that, investors, lawyers are going to want to go through the ownership structure. They're going to want to look over all of the contracts, the vesting, everything for the founders, something which investors should actually look at prior to even a safe or a convertible, right? But this is where it's really going to be scrutinized, right? They're going to really look at the core of the business, the IP, processes, frameworks that you have in place, and it comes under, a lot of scrutinization and a magnifying glass, right? And this requires a lot more time and a lot more effort from lawyers, from investors, and also from founders. So it is more expensive. It is a lot more rigorous, and it's a much longer process than a convertible or a safe note. And again, a convertible and a safe note, they're again instruments to allow for easy investing, right, into a company. It's like there's a lot of information we don't have now. There's a lot of things that we can't figure out right now, but we see this as a good opportunity and we want to invest now. So, and again, as a founder, I recommend, without having too many people on your cap table, and having, 30 convertible notes, leverage these convertible or safe notes to get just enough money to be able to hit really, really good milestones, right? And try to squeeze every ounce of efficiency out of those dollars that you raise.
Right. And when we talk about safe notes, as when you were explaining them, you talked about, discount valuation cap. Now, what are the, again, I mean, I'm sure this will not be an easy, there will not be an easy answer for this, but from your experience of working as a VC in the region, what are some of the standard terms that you see in a safe round in terms of valuation caps for early stage companies and valuation caps and the discount? What are some of the standard terms that you see? What is the rate that early stage startups look for?
Yeah, so discounts can be, again, anywhere from 5% to 20. I think anything over 20, unless it's a very high risk business, right? I think that's a little bit too much. And that's all negotiable, right? I mean, the standard is usually 20, right? Usually 20% discount. Now, on the valuation cap, again, it's really, really tough, right? I mean, it depends on how much money the investor's putting in. If an investor's putting in $1 million, right, they may ask for a valuation cap that allows them to get, 30%, 40% of the business, right? But again, that depends on, if I came to you with an idea, right, and I had no product, I have no users, I have no traction, that could be justified, right, for an investor to put in that much money and get that big of an equity stake, which is, again, why I always recommend founders and entrepreneurs to really push for as much progress and bootstrap and do as much as they can with their time, their sweat, and a little bit of money, maybe friends and family money. But there's really, really too many variables, right? It's all relative, right? Relative to the company, their progress. It may not even be their progress. It may be the founder's ability, right? It may be that somebody is a third-time founder and that there's a high level of confidence that the investor has that this individual will create another successful venture because they had three ventures before and one of them failed, but two of them were successful, right? That's leverage, right? That the founder actually has to negotiate and retain as much equity as possible.
Right. And using an example, let's just say that I'm a founder. I'm raising through SAFE. I raise, let's just say, $100,000, and the valuation cap is 400,000. And then I go and raise another round, and I raise, let's say, $300,000, for example, and the valuation. This is a price round. The next round is $1 million. What will the investors of my first round get, who invested with the valuation cap of 400,000 in a
So
SAFE?
they get 25% no matter what, right? That's the whole purpose of the SAFE, right? So they invested $100,000 at a $400,000 valuation cap. That means that no matter what the future valuation is, they are going to take 25%, right?
And if the valuation of the future round is actually lower than the valuation cap that was set in the round, what would happen in that case?
They get more, right? They get more than 25%, right? And so that's something that, again, as an entrepreneur, like you want to strive to ensure that that doesn't happen. There's another thing that I didn't mention, which is most favored nation clause. What this essentially does, it allows an investor who invested earlier to get the same deal, if it's better, as any future investor. And this, you find it in convertible notes and SAFE notes as well as a clause. So that says, if I had a valuation cap of $400,000 for my 25% and a 15% discount, but the next investor got a $300,000 valuation cap and a 20 or 25% discount, that automatically entitles the earlier investor to get that same deal. So that's something that investors kind of push for. They push for as well.
Is it common in the region?
In the region, I've seen it a couple of times through some of our portfolio companies, but not a lot. It's not very, very mainstream.
Right. Let's just talk a little bit about what should the founders know when they are getting an investor on their cap table. I know we've already discussed in one of the previous two sessions, but if we can just quickly go through these things they should keep in mind when they are getting an investor on board. For example, that this investor is probably going to stay with them for the entire life of the company, unless there is a mechanism that allows them to exit early. What are some of the other things that founders should keep in mind when they are bringing an investor on their cap table?
Sure. So I think first and foremost is whether they're going to be a passive or an investor or an active investor, right? Passive as in, I'm here to give you money because I believe in you, and this is just an investment for me, and I'm not going to think about it for a few years. Or if I'm active, right? And if they're active, what is the value added that they're actually going to contribute, right? As an active investor, it may be business development, it may be relationships, it may be just advice, right? Somebody who's in the industry who can help you work through some of your challenges with your product, or et cetera, right? Some of the strategic investor considerations is industry access, follow-on funding. Is this somebody who will invest now and also has the potential to invest down the road, right? So you would use your existing investors. Your best future investors are your existing investors, right? They know you, they have the relationship, they've already made a bet on you, right? So for them to continue betting more on you versus somebody who you don't have a relationship with, right, is a lot easier. So follow-on funding is very important. It also could be mobilizing funding from other investors, other people, like they're your biggest advocates, right? I believe in Zubair, I like him, I know he's going to do well, and I'm going to solicit that to my other investor networks, and they may be able to raise funds for you there. Another thing to consider is if they are going to be an active investor, are they going to, is that somebody that you're going to want to deal with? Are they difficult to deal with? Are they challenging, or are they helpful? Right. Another thing is looking at, their existing portfolio. For example, maybe you don't want an investor investing in your company who has in their portfolio, they've got a lot of, maybe gambling investments in like casinos, for example, right? or, or maybe they have something that is, they're in their portfolio, they have a direct competitor to you guys, right? Maybe they're trying to diversify their risk a little bit, or maybe doubling down, betting on a specific industry or something like that. But that's something that's a concern for you, right? You don't want maybe some of your IP going to, or some of that knowledge that they have. And most investors are obviously very ethical, and they won't share that, but sharing that with somebody who's a competitor that's also in the portfolio, or close to being, right? So these are just some of the initial considerations.
Right. And when founders are trying to evaluate if they should potentially take money from an investor or not, who should they reach out to learn feedback about this particular investor? Because you cannot take with their word for it. They could be saying something, and it could be totally the opposite.
Correct. It's a really good question. So who should they ask? Maybe they shouldn't ask any of their if they have existing investors, right? It's a small investor community, right? Ask your existing investors, hey, have you co-invested with this investor before? What is their structure like, et cetera? Look at other founders, right? Go on their portfolio page, look at the companies they've invested in, talk to those founders, say, what was it like raising money? What value are they providing? Are they active or passive? All of these questions that you have, right, around the attributes of this investor, right? You can essentially get that from best sources, going to be from other portfolio companies that have gone through the process, right? They'll tell you, validate some of your ideas, or again, just be able to articulate to you how it's been working with that investor.
Right. And how important do you think it is to be able to assess or evaluate an investor before taking their money, for founders?
Would you marry somebody without getting to know them? Literally, it's like, it's a long term. Like, if you think about it, it's a long term lockup. Like venture, when you're talking about early stage ventures, right? You're getting into a relationship where the average maturity is somewhere between 7 to 10 years, right? For a company to go from idea or early MVP to exit. That's a long time you're going to have to deal with your investor. Again, if they're a passive investor and they're just quiet and they say, you know what, I'm investing in this, in 10 years, it may give me a good return, it may not, but I'm okay with it. This is my investment thesis. That's fine, right? If it's somebody that's going to bug you, once a week for 7 to 10 years, you may want to think about that, So it's super critical, right? This is a long-term type of relationship, right? I would say almost as important as if you're going to co-found a company with somebody, who those co-founders are. The only difference is co-founders, you're definitely going to see them every single day, right? Whereas investors, even the most active investor, you're not going to engage with them at that capacity, right?
Right. I think from my experience, at least, a lot of founders in the region make this mistake that they don't really do their due diligence on investors. Like, they are the investors obviously do their due diligence on startups and founders, but there's very little that is done from the other side. So I think founders should really be careful about that, because obviously every ecosystem has bad actors, and you don't know until you try to speak to their portfolio to you actually learn the right feedback, as you said, from the founders they've already invested in. So perhaps that's the best approach. I think we're done with please go ahead.
Yeah. So I agree with you. I agree with you 100%. It's like it's really important, right? Founders, like, take your time, do your research. I know it's tough, right? And I know it's tough when you're struggling, when you're not getting paid, or whether you're getting paid a living wage, whether you're overworked, you and your team, you're putting in like 16, 18-hour days, maybe even more. I get it. And that's the sacrifice. And that's why you own this, right? That's what's amazing about entrepreneurs, right? Is that you have the ability and that grit to be able to, like, fight through it. And literally, like, hats off to entrepreneurs for being able to do that. But, like, I know there's a level of relaxation or comfort, right, when you have financial security, right? Even in your own personal life, right? Like, if you don't have a job, you probably can't sleep at night, right? Because you have bills and you've got requirements, right? You have a job, like, you're more relaxed. You've got steady income, you've got stability. And I know also, as a founder, it's not just you, right? It's you and your team, right? Like, You have other people that you're responsible for making sure they get paid at the end of every month. That's not an easy burden to bear, right? And that's what makes founders so incredible and resilient, and what I love about them, right? So I get it. Point being here is I know that it's tough, but do your homework, right? Do your homework. If you have a good product, if you're a good, hardworking founder, and you're ruthlessly persistent, right? Like, you will find a good investment. You will find investment. You will find good investors that'll support you and believe in you.
Right. Thank you so much, Kareem. I think we're done with everything that you had around slides and the topics that were supposed to be covered in the session. We'll now log off from Facebook. We'll continue with the Q&A on the Zoom session. Thank you so much
Great.
to everyone
Thanks.
who joined us on Facebook. We're off Facebook. Now the floor is open for the audience here. We've got a question from Muhammad. I'm going to, okay, Muhammad. Go ahead, Muhammad.
Assalamu alaikum. So I have bootstrapped it for 2.5 years, and I have invested from my own money $40,000, and so for 2.5 years. And like you're saying at the beginning that when you go to investors, you want to see like vesting for shares to ensure that the founders will stay for some time. But like at this stage, after investing that amount of money, for sure, I'm not be willing to vest my shares over time. You see what I'm saying?
Yeah, I totally get what you're saying. And look, like, I think there's a middle ground, right? It could be that you agree with your investors. Look, you know, let's say you're going to own 50% of the company, right? You can say, look, I want 25% immediate ownership because I put all of this stuff in, but the other 25% is going to vest. So you got to understand the reason why investors do it, right? They do it because you, Muhammad, if you leave the company could very well be worthless. It's not going to operate the knowledge that you have, the experience, the knowing what has been working and not working for the past 2.5 years for the company. That is very, very important to the investor. I wouldn't want to risk investing $500,000 or $100,000 into a company where the value creators, right, the key men, the key people who are the value creators, like you and your other co-founders, have a risk of leaving, right? Why? Because Muhammad, you may be able to, for example, go and on one of your business development calls with a potential client, that client can be a big corporation. Instead of you getting them as a customer, they may say to you, well, come work for us and we're going to give you a $250,000 a year salary and all these benefits and, right? Like, you, as an investor, I want to make sure that you are in it for the long haul, right? And this is why I would want you to invest. So I totally get your perspective. I totally get where you're coming from. You've definitely earned your keep, but remember that it's a negotiation, right? It's not black and white. So just keep that in mind.
Sure. Thank you all.
Thank you, Muhammad. We've got another question, Muhammad Naeem. Go ahead, Naeem.
Hello, Zubair and Kareem. Thank you very much. So I got two questions, actually. One is very basic, fundamental question, and second is, I hope it's not a problem. So first question is, there's a lot of definition. So what's the definition of an early stage startup in the eyes of an investor?
Yeah, so it's a very, very broad definition, right? That can be early stage, can be in the proof of concept stage, right? So the validation stage, where I know a problem very well. I know how to make a solution, or I'm trying to solve that problem with a solution, and I'm just testing and iterating till I find the right combination of features or offerings that makes this a good solution to where the market is actually picking it up and you're gaining traction, right? So it could be as early as that, right? It could be idea stage where it's just an idea. It could be proof of concept. It could be where you have traction, but you're not making any money yet. So pre-revenue, right, is also considered early stage, or revenue I want to say that where the company is below break even, right? So if you're getting revenue, but you're still losing money, right, you could consider that early stage. The only problem with that definition is that there are companies that are late stage that still, like Facebook and like Uber, right? Airbnb, these guys are losing tons of money, but they're very late stage companies. They're not break even, right? So the unit economics is probably the weakest definition. But I would say early stage, I would consider anything before probably a price round, before an A round. I think it's probably safe to say. What do you think, Zubair?
I think maybe, product market fit could also be an option, a milestone for it to be based around. Once you achieve product market fit, you're trying to grow your startup, you're trying to expand beyond your current market and probably expand into other areas too. So at least, I mean, from my perspective, we consider any company that is raising a pre-seed or seed round early stage. Anything that is beyond that, even those that are trying to raise a bridge round to their Series A, for us as a publication, as MENAbytes, that's not early stage. We consider pre-seed and seed companies early stage, but like Kareem said, there is no standard definition, and it's very broad. It depends on how the person who's saying is this frames it. It doesn't really have a standard as far as I know.
Right. Okay. So let me ask second question. Thank you very much. So that's a pretty much scenario-based question. Let's say Zubair and Kareem owns a startup. They're two founders, and they want to bring in third founder, which has a lot of value to add. But the third founder is asking for a lot of equity. In fact, more than what actual founders would be interested in. In fact, double of that. So how would you tackle that? I'll give an example. Let's say it's a startup related to mental health issues, and the third founder is coming in. He's expert in mental health, problems and all these things. So he's saying that, give me 30% of your equity. And the startup is in early stage in terms of more like a revenue generating, but it's not revenue, but let's say, for the sake of saying that they are making $2,000 per month, but still they have spent, both founders have spent $100,000 on the, by bootstrapping and all these things. Third founder coming in, he's not putting in money, but he's just offering the, expertise and all these things. But at the same time, he's asking a lot of equity. So how would you tackle that?
Yeah, so it's also relative, right? That's another relative circumstantial situation. But how? Best approach is to do a cost benefit analysis, right? What is the cost of this equity? What is the benefit that you're going to get, right? If this founder or a potential third co-founder is, for example, let's say they are, I'm going to use a different example from the one you presented, if that's okay. Let's say you are a SaaS company, right? And you offer software. And this co-founder is coming in, and what they're going to do is they are going to give, their strength is, strategic guidance, right? Versus a co-founder, like they may, for that strategic guidance, no, 30% may be a lot, right? That's the cost is much higher than the benefit that they're getting. But if you're a SaaS company and you work in the healthcare field, right? And what you do is you hire this third co-founder is a business development expert in medical software sales, right? Who has a very, very big network, right? Of corporates that are your target customers, right? So he can bring you revenue, he can bring you big accounts, right? And second, he has the ability, because he has previously set up and managed a business development team, right? That will continue for him to build locally, and that will continue to bring in, additional clients, et cetera. That may be a very, very high value, right, for you, because you're trying to bring in revenue, trying to bring in customers, and he's essentially like your customer acquisition. Said different scenario, right? Let's say you are a direct consumer brand, right? Where your funnel is primarily focused on digital growth, right? Conversion, right? And you have a conversion funnel of consumers. Maybe a founder who is a head of digital growth or a growth hacker, right? Or somebody who's expert in that. Again, they're helping you. It's directly correlated to the growth of your business, either money-wise or user-wise, right? That has a much higher value than, again, somebody who's coming in from a strategy perspective, somebody who's coming in from, an operator perspective, and also like that skill set in the market, right? Is that a skill set in the market that you think, is it more, excuse me, is it cheaper to find somebody and just pay them a good salary and not give equity, right? Or is it, if you have the ability to do that, or is it better for you to save your cash to pay for tech development and bring somebody in who will actually be bringing you customers? So again, I apologize. It's all very like circumstantial again, but I'm just trying to give you kind of like some scenarios where what are the things to consider. But fundamentally, it really just comes down to like doing a cost benefit analysis.
Okay, thank you.
Is it also possible to perhaps you can do vesting, that's an option, but is it also possible to link vesting with some specific milestones instead of let's say a cliff period of 1 year, or how does that work?
100%. And that's what I was saying for advisors, for example, right? Or it doesn't have to be for advisors, but you see it mostly with advisors, right? But you can do it. Let's say somebody is, you have this, ahead of digital growth, right? And again, that's customer acquisition is your main play, right? You may make milestones that is X amount of users per quarter, and it may vest per quarter, right? If you hit these, you set milestones on how many users or how much revenue, or how much traffic, whatever the case may be, whatever growth metric you have, and you assign that as being the triggers that actually unlock the vesting, right? That actually has the vesting execute. So you can be as creative as possible, right? It's just, you got to understand it's like a tool, right? Like you can use this tool for multiple things, right? You can use a hammer to hammer nails. You can use it to put a dent in a car. You can use it to bang wood out. You can use it for a lot of different things. So you got to think about it that way.
Right. Thank you, Kareem. Do we have any other questions? Yes, Payam, go ahead.
Hello, Zubair and Kareem, how are you?
Thank you.
Actually, I got two questions. First, I want to know, because do you advise to, for starting this process, first approach to advisor or no? Okay. And because one of the biggest challenge I faced with my first actually startup, finding right advisor. Okay. And second, is it secure if we share the data and pitch with the advisor or no? There's a two questions.
Sure. So yes, I think you should. Look, guys, you guys may think that have a lot of experience in the space. I'm fairly young and new to it. I have advisors. I have multiple advisors, right? I think you should always have an advisor. An advisor is, I have this saying, if you as a founder, if there's like a jar, right? Like you're inside the jar, right? Because you're the founder. So you can't read the label, right? Because you're inside the jar. An advisor can come in and say, hey, by the way, like this is what the label's saying on the outside. That perspective is critical, right? So I think that you should surround yourself with one or a couple of different advisors that you're close with that will provide the right type of value added. And advisors change, right? An advisor for an early stage company, maybe somebody like me who's built them before, but an advisor in a later stage, as you go later stage, maybe somebody who is addressing the needs that you have at that point, right? Maybe I can only advise you to a certain point, and then, things change and it becomes out of my expertise, and you need another advisor. So yes, I would say always have an advisor, always as soon as possible. And what you'll find is a lot of senior people, they like to give back, right? It's paying it forward it's always the thing to do, Zubair and myself, when Zubair, a few years ago, when he was starting MENAbytes and I was starting out in the region, he was an advisor to me, introducing me to great founders and companies and helping me, learn about the ecosystem. And I was helping him with some of the stuff that we're talking about today when he was fundraising, right? So I think it's always valuable. Now, as far as sharing sensitive data, look, if this is an advisor and somebody who's a professional, I think it's okay. Definitely have an NDA, right? Maybe have a confidentiality agreement, like a non-disclosure and confidentiality agreement. Always make sure that that's signed with anybody that you engage with, right? Employees, advisors, anyone, right? This is just good this is just good practice, right? Me as an investor, I'm going to go look and see if you are sharing your IP or your sensitive information with a lot of people without putting these protective mechanisms in place. I'm going to think that, you know, you're probably missing something very important, and that's not very good management, right? Management discipline. So just make sure that you have some documentation where, you know, that addresses it, that ensures that they're not going to share that information, and they're going to keep it confidential, and you should be okay.
Thanks a lot. Thank you.
Sure, no problem.
Thank you, Pam. We've got a question here in the Q&A tab. Shiva is asking, he's asking, in your experience, how common are the convertible or safe notes in the Middle East, especially compared to the US? He's saying that from his personal experience, he has spoken to many investors, but 9 out of 10 would say that they would not invest in a safe, using a safe note, but would rather have a price round, and they are an early stage startup. He's also asking, how do we build awareness of convertible and safe notes in emerging markets?
Yeah, so I think that's a function of investor education, right? And same way that the entrepreneurial ecosystem is still developing in the Middle East, so is the investor ecosystem, right? You could probably count on, you know, 3-4 hands, like the amount of investors that actually understand the best practices, and mostly because maybe they're coming from a Western market or they have some sort of background, professional experience, right? So significantly more prevalent in the US market, right? It's very standard. It's very, very commonplace. I do see it coming here quite a bit, but I can understand if there's an investor who is, you're probably finding that with, you know, investors who are high net worth individuals, family offices, not non-professional investors, right? And what they're used to is you know, a very cut and clear, I put in this much money, and I get this. None of these variable mechanisms that are to be determined at a later date. If they don't understand it, then they're not going to be comfortable with it. So, you know, it's understandable. That's another thing that you want to consider when you're raising money. Is, do you want an investor who thinks a certain way or acts a certain way or understands things a certain way, right? Because maybe they're going to be more or less flexible. And I think the second part to your question was how do we
build awareness around convertible and safe notes in the emerging markets?
That's, you know, put it in front of investors. You know, blog about it. You know, I know some entrepreneurs who have had really bad experiences giving away a lot of their company in the beginning. Sharing those experiences, I think, is kind of the best way. You know, for me, I think it's more of a you know, a grassroots thing. If investors, if the function here or the shortcoming here is investor education to these instruments that are widely accepted in the US, then we have to put this in front of them more, right? We have to help educate these investors, or at least, you know, bring it to their attention that, look, this is the standard, this is what's used. I already have investors that have done this. And then they'll go and they'll do their research. Like, look, I have this conversation all the time. Why? Because we invest in companies using safe notes, using convertible notes. And then what you have is these companies have other investors who are not familiar with it. So what they do is they come to me as an investor and say, explain to me what this is that, you know, that the founder is asking me to sign. I am not used to this. I don't know this. So I personally do a lot of educating to other investors, right? New investors or old investors that just don't know these mechanisms, right? That don't understand this. Maybe they're new to tech, for example. And so I think that's really the best way to do it.
Right. And in terms of institutional investors, especially those who invest at early stage, do you think that this is the case, that a lot of them would not invest using a safe note? Because at least the conversations that I've had with founders, the investors are usually, I'm talking about the institutional investors, again, the VC funds in the region, the early stage VC funds, they're comfortable investing using a safe note.
Correct. That's pretty, because again, most of them, they don't want to do the work, right? Like, remember we talked about how much work is involved in doing a price round and due diligence, and that's a lot of work. Like, who's going to do that? the VC is going to have to do that, right? They're going to have to pay a lawyer to do it, right? Like, so for them, it may not be worth that, all of that effort for a company that's at an idea or a proof of concept or an MVP stage, right? So,
right.
Yeah.
Thank you, Kareem. Naeem, do you have another question?
Not really, actually. Pretty much clear. Thank you.
Great. If anybody has any other
that,
questions.
I think Muhammad has another question.
So what's the ticket size of Modus Capital, and like what kind of startups do you look for?
Great, that's a great question. So our ticket sizes, we do from anywhere from like pre-seed or seed. It can be $150,000 up to $500,000, or seed and Series A, right? So we can go up to $1.5 million. So we actually cover the most of the early stage investment spectrum. That's our ticket size. Industries, we're industry agnostic. We don't really touch anything that has to do with hardware and production and manufacturing. Usually it has a whole other set of challenges that, you know, we're not very accustomed to. It's not our strong suit. I've had some previous experience with a company, consulting for a company that had a lot of challenges for it, so we stay away from that. Industries that we are strong in is anything direct to consumer, where conversion funnels is a core part of the business. We're very, very strong in supporting companies with that because we have an operations team that supports our portfolio companies. Health tech, any utility, blockchain-based utility applications. So core functionality around maybe email, doing real estate deals, for example, on blockchain, smart contracts, etc. That's something that we're big in. SaaS, enterprise SaaS, is something that we're very, very big on. What else? Marketing technology, we're big fans of, although we don't see a lot of that here in the region. And obviously fintech. Fintech's a big player right now in the region, and something that we focus on.
Hey, let me ask, thank you for answering that, but let me ask
Sure.
a follow-on question on that. Like, okay, so you said the ticket size is between 150 to 1 million or 1.5, it depends. But like, when you usually put that kind of investment from that range, what kind of revenue are you looking, and what kind of growth are you looking? Like, how do you, like, okay, if they are getting this much of revenue, or if they are getting this kind of growth, I put between that range, or how do you measure it?
Yeah, so it's again, it's all relative, right? So for example, we won't invest $1.5 million into a company that is building an MVP, right? Like that's outside of that scope, right? But we would put, if the founder is very smart and understands a problem or an industry very well, we would put $150,000 into somebody who has an idea, right? We're willing to do that, right? And then it goes along, right? You know, if a company has some early like validation, they're not making any money yet, but they have early validation, and they have, for example, early product market fit. They have users. Those users are engaging a little bit on their platform. That's a company we would put in somewhere between $250,000 to $500,000 and to get them to the next level, right? Okay, you've got some traction. Now we need to continue validating that or begin growing, right? Company that we would put, $1 million or $1.5 million in. Company that's making revenue. What does that revenue look like? Doesn't really matter if they're getting users, for example. If they're getting a lot of users and they're getting a lot of traction on the top of their funnel, maybe what we're doing, we're investing that money because we want to get them to the point where they're going to monetize off those people in the future. So it's all very relative. Again, it depends on the industry, the type of business, the metrics that they are using and they are looking at. And then from there, we make an assessment.
Thank you.
Sure.
Right. So we've got last question of the day from Shiva. He's asking, Given COVID, a lot of businesses for growth have taken a hit, especially for certain sectors such as transportation and mobility. With a lot of uncertainty in the future, would it be safe for a startup to raise a convertible rather than a price round at a lower valuation?
Yeah, look, convertible gives you way more flexibility, right? So I would always recommend a convertible. You know, a price round, I wouldn't go into a price round unless you have the ability to substantiate a valuation, right? And in order to do that, you need to have a certain critical mass of, of data to be able to substantiate that valuation off of. So, I think that, investors, what they're looking for right now is, they're looking for good deals, right? We know that companies have been taking a hit, and there may be some companies that have good founders and still have good potential, but the timing isn't right. So for that, as an entrepreneur, I would recommend doing a convertible or a safe.
Right. Thank you, Kareem. Last question of the day. What is the average duration to close a deal?
So a convertible note, usually you can close it in as soon as a couple of weeks, like a week or 2 weeks, right? If you're talking about a price round, assume that it's going to take twice as long as what the VC tells you, like automatically, right? Definitely twice as long. That can be anywhere
Even
from
Modus?
Even for Modus in the beginning, we've done a couple of price rounds, but because it was our first, lawyers, and there's a lot of things, and we're also learning about the ecosystem. So yes, for us, we did a couple of price rounds, and they took a lot longer than we anticipated, right? Because for us, for example, this is the first time we've had exposure to a company that's UAE based, but also has an entity in Egypt and also has an entity in Delaware. And then the legal team has to do the ownership of these 3 entities together. And yeah, so we were exposed to new things as well. But on average, if you're talking about a price round, assume somewhere between 3 to 5 months, right? From the initial conversation, due diligence, also consider, it also depends on how much other investors you have, right? So if you have all of your investors, for example, lined up, but you're only looking for a lead investor, and that lead investor is going to be the one who's going to do the pricing and all of that, then it could only be 2 or 3 months that you guys are doing that doing that determination.
Right. Thank you so much, Kareem. Thanks a lot, everyone, for joining in. We'll have the 4th session, which is the final session of the online bootcamp, perhaps after the Eid holidays now. The next Monday, I think it is going to be a holiday for Eid. So we'll probably skip this week and have it the week after, like we did this time. All of you who received the invite, if you would like to receive an invite, again, you'll receive an email and you'll have to confirm that you're able to attend, and you will receive your invite to attend this session on Zoom. Otherwise, for those who would like, they can also watch it on our Facebook, but they will not have the opportunity to ask questions. Thank you so much, Kareem. Thanks a lot for taking the time once again.
Thanks, Zubair. Also, everyone, if you guys want and have any other questions or any of the information that we presented, please feel free to check out our Facebook group, Modus Masterminds. We're there to answer any additional questions in more detail, myself and also the greater investment team. And follow us if you're looking for some good reading material. We've got some pretty good stuff that we've been pushing out on our blog recently.
And the link to Modus group on Facebook is here on Zoom. So if you'd like to join, you can click. And I think we've emailed that as well earlier. We'll probably share it in the next emails as well. Thank you so much, everyone, for joining in.
Thanks, everyone.
Thank you, Kareem.
Thanks, Zubair. Thanks, Zubair. Take it easy. Bye.